Assalamualaikum and hello everyone. In this lecture, we will discuss the calculation of cash flows from financing activities. While we have previously discussed this topic in detail, let's quickly recall that cash flows from financing activities track cash movements between a company and its investors or creditors. So this section shows how the business raises money to fund its operations or growth. We have cash inflows and outflows from these activities. The first one is short term and long term borrowings. So, this is the cash received when a company takes out loans or issues bonds, whether for a short period of time or long period of time. So, borrowings provides the company with cash that can be used to fund its operations or expansions or other needs. Likewise, whenever a company issues new shares of stock, it raises money from investors. So this represents cash inflows from shareholders who buy the new shares. In contrast, we have outflows from financing activities. Like number one, make payments on borrowed funds. So this includes cash used to repay the principal amount on loans or other debts. So this includes only the principal amount. Payments on interest might be classified as operating activities. So only the principal amounts comes under financing activities. The other one is owners for dividends. Cash paid to stockholders or shareholders as dividends is also considered as financing activities, and this represent outflows. The next is the purchase of treasury stock. So whenever a company buy back its own shares from the open market, this is called as treasury stocks. Buying back shares is the outflow because it uses up cash, reducing the total number of shares held by the public. Or in short, in summary, we can say that financing activities reflects how the company is funded by debt or equity and how it returns the value to its lenders or its shareholders. So the inflows increase, cash raise by short term or long term borrowings or issuing new stock to the shareholders, and outflows by making payments to on the borrowed funds or the dividends or the purchase of treasury stocks. So we are going to practice the calculation of cash flows from financing activities from the book Financial and Managerial Accounting by Williams Haka Bettner. And we have brief exercise 13.6 in front of you. So, this brief exercise given us the data which we have. The Texas company sold common stock. So, sale of common stock or issuance of common stock is a part of uh, financing activities, and likewise selling of preferred stock is also part of financing activities, whereas the company purchased treasury stock. So treasury stock, purchase of treasury stock or buying back its own share is a part of financing activities, whereas the paying dividends, so the paying of dividends is also the part of financing activities. So determine the amount of cash provided by or used for the financing activities. So we are going to calculate cash flows from financing activities. We have, first of all, we have issuance of shares, so company sold. So we have proceeds from issuing of ordinary shares or ordinary stock, you can write down ordinary stock, which is $560,000. So we have $560,000. Then preferred stock, so proceeds from issuing of preferred shares, which is $36,000. Again, we have purchased treasury stock. So cash paid to purchase of treasury stock. So this is just like buying back its own shares from the open market. For this, the company has to pay cash to that shareholders. So that's why we are deducting it from the total, and which is 35,000. So 35,000, and then dividends paid on common and preferred stock. So cash paid for dividends, and here we are deducting it $24,000. So the total cash here, this is the total cash. We have cash provided by or used for. So as this is the positive amount, so this is the cash provided by. So this is total cash provided by financing activities. So this is our answer from this brief exercise. The next, which we are going to cover it in this lecture, is exercise 13.14. So moving towards 13.14, here we have this problem. So the company's cash flows, we have cash inflows and we have cash outflows, and the requirement is to calculate net amount of cash whether provided by or used for financing activities. Only financing activities. So we will like include only those activities that are related to financing activities, and we will ignore operating activities or investing activities. So the first one is cash receipts from customers. So these are operating activities, so we will not include it. Then we have sale of bonds. So sale of bonds, as we have discussed, yes, sale of bonds. These are, sale of bonds are the financing activities. So we will include it. Here we have this. We are going to include it. Treasury stock again is a part of um, financing activities. We will include it. And then interest and dividend received. So interest and dividend received, we generally treat interest and dividend received as operating activities or investing activities. So we are not going to include these in financing activities. And then we have sale of equipment. So these are investing activities. We are not going to add it. Then we have payments to employees. These are operating activities. Payment to purchase inventories, again operating activities. Dividends on common stock. So dividends on common stock, yes, this is the part of your financing activities, as we have just discussed. Purchase of treasury stock, financing activities, and the interest expense. So interest expense is again is we have two different rules, whether we if we follow if the company follows US GAAP, generally accepted accounting principle, the treatment of interest is different. And if the company is following IFRS, or you can say international financial reporting standards, then the treatment of interest expense is different. So we will discuss it, and we are going to mark it here, because this is we have different treatment of it. So calculate the net amount provided by, okay, we have two different rules, or regulations. If the number one is, if the company is following US GAAP. So first of all, we are calculating cash flows from financing activities, a requirement. Cash flows from financing activities. And this we are using if the company is following US GAAP, generally accepted accounting principle, because the treatment of interest expense is different in this case. So, um, cash flows, we have cash receipts from the sale of bonds. So, proceeds from sale of bonds, and this we have dollar, how much amount? $400,000. 400,000. Then we have sale of treasury stock. So proceed from sale of treasury stock, and the amount is $34,000. Then all our other activities, and we have dividends on common stock. So cash paid for dividends, which is negative because it is cash paid, and the amount is 60,000. And then uh, purchase of treasury stock or buying back shares. So cash paid for treasury stock, which is $20,000. So we are deducting it minus 20,000. So this is the total cash flows from financing activities. And this is the case if the company is using US GAAP, because the company, if the company is using US GAAP, or following US GAAP, this means that company is treating interest expense as operating activities. The company is not considering it here. Whereas if the company is following IFRS, here, this is the answer: cash provided by financing activities. So this is the total cash provided by financing activities. And if the company is using or following IFRS here, International Financial Reporting Standards, so IFRS. Okay, so the treatment of interest expense would be different, because in this case the company is treating interest expense as financing activities. So here we are going to use cash paid for interest expense. So we are deducting interest expense, which is $78,000, 78,000. So here you can see the cash provided by financing activities are different. So in simple, if the company is in US, this means that the company is definitely following GAAP. And this is for other countries, or for those companies that are following IFRS. So this is just the way of classification of interest expense. The total cash flows will not be affected whether the company is representing interest expense in as financing activities or as operating activities. The second requirement is briefly justify why you excluded any of the other items or the other above items in your calculation in part A. So in part A we have excluded receipts from customers. So these, because these are the cash flows from operating activities. Likewise, we have excluded interest and dividend received. So interest and dividend received are part of operating or investing activities. If we are following US GAAP, then cash received from interest and dividends are part of operating activities. Otherwise, it is the part of investing activities. And then sale of equipment, we have discussed in previous lecture that sale of equipment is a part of investing activities. So this is the answer of requirement number 2, that why we have excluded these are from calculation of financing activities. So payment to employee is again the operating activities. Payment to purchase of inventory is again the in part of operating activities. So, for the answer of part C, briefly explain your treatment of interest expense in your calculation in part A. Although we have already discussed here the treatment of interest expense in under US GAAP or IFRS, actually the interest expense could be classified as a financing or operating activity in the statement of cash flows. Interest expense is classified as a financing cash flows on the ground that it is a cost of obtaining financial resources. That's why those companies who are following IFRS, these companies include interest expense here in financing activities. While in United States, under GAAP, it classifies interest expense as an operating cash flows on the ground that the interest expense is an ordinary cost of doing business and is included in the determination of profit. So this is the classification of interest expense in both cases. So that's it from this lecture. Take care, class.